Hello everyone, welcome to yet another episode of Investor Insights. I'm Joanne from IPP Financial Advisors, and today joining me is Daryl from iFAST Financial and also Kenny Jan, who is the fund manager of iFAST Enhanced Liquidity Fund. iFAST Enhanced Liquidity Fund has an AUM of 916 million Sing dollars as of 31st of March. Let's welcome Kenny to be able to share with us insights about the fund and also some of the common questions that my clients have raised. Let's get started.
Okay, so I'll kick off the first question, Kenny. So could you explain more about the composition of the fund's underlying assets and what kind of instruments are included?
For the Enhanced Liquidity Fund, because it is a liquidity fund, so the kind of instrument that we use are relatively safe asset class and instrument. So you're talking about, of course, cash. You have also your MAS bill, the treasury bills, and we also put some of the money into fixed deposits with very renowned financial institutions. And at the same time, I think also to ensure the liquidity is there, we also invest and look out for other money market funds that actually provide us with a relatively decent yield. And because we work with a lot of partners at iFAST, so they are very happy for me to also put money into their funds. And last but not least, of course, when I find opportunities in the investment grade bond space, then I will also try to get a bit of a higher yield kicker through investing in some of those so-called investment grade bonds.
Another question I have is does the duration of the assets match the liabilities?
Yeah, I think in the ideal world, the best is, of course, you have duration that the asset matching liability. But because we are trying to give higher yield to our investors, so the duration of the asset would usually be higher. If you look at, in a theoretical basis, the liability of the fund is almost like T plus zero. It's like if you want money, you can draw all the money at a time. But I think like what you put money in the bank is like a current account, right? The bank will not put all the balance in the current account in just a overnight deposit or same day deposit. So what if in the objective of trying to provide a better yield, we need to have a bit of a duration mismatch between asset and liability. But having said that, I think it will be very imprudent for me to invest all the asset into like a 5-year, 6-year corporate bonds. Although you will get most probably higher yield, but I'm trying to match the liability of so-called instant withdrawal, for example. So what we need to do is that we will assess the liquidity requirement, the client profile, and what we try to do is that we will have a bit of a duration mismatch, but it will be pretty minimal. Like for example, the Enhanced Liquidity Fund that we currently manage, the duration is roughly about 0.2 to 0.3 months. So it's still a very short kind of instrument that we invest in.
How do you evaluate the debt instruments to ensure that they are safe for the investors and that they are able to minimize risk and yet give returns to the clients?
Yeah, I think as a first protection, the fund has a minimum credit rating of A-, which means that for those like high yield bonds or whatever, it's definitely a no-no for the fund. So what I will look out for in terms of the safety of the instrument, firstly, you look at cash, of course, it will be the safest, so I put my cash with our custodian bank, which is Standard Chartered. And then secondly, you also look at overnight deposits with some of the key financial institutions in Singapore, some of the local banks, they're regulated by the MAS. And thirdly, of course, MAS bill, I think a lot of people also understand like treasury bills right now. I think a lot of people, because when the interest rate were very high, everybody start to dabble into it, and now they are getting very familiar with it. So MAS bill and treasury bills will also be something that we invest in. So these are pretty much very safe instrument. And then on the money market front, like you have all the big money market fund out there, like the Fullerton, the LGI. So those will be those money market fund that we also aim to deploy some of our AUM into, especially looking at which one is actually paying higher. And most of those money market funds currently are a T+1 settlement. So in terms of liquidity, there will be also quite a bit of safeguard. And also because this is an authorized fund, we also limit our exposure to maximum 10% of the total AUM of the underlying unit trust that we invest in. So that also give us a bit of comfort to make sure that we are not the largest kind of investor to your fund. So when we need to redeem, it will pose some issue. So that are some of the consideration. And last but not least, the corporate bonds, which actually give us a yield kicker. So that would be, I would say, the one that perhaps require a bit more work. At iFAST, we do have a very established fixed income team doing fixed income research. So for all the bonds that we invest in, and they must be investment grade bonds, we typically would prefer those bonds that has a relatively short duration of less than 2 years. And then our fixed income analysts will conduct research on those bonds and make sure that I'm comfortable. And since because I have been a fund manager for many years, so I also have my opinion on some of those names and the institution. So I think that will be a safeguard for us to look at some of those corporate bonds when we decide to include that into the portfolio.
So I think, Kenny, in an environment where interest rates are fluctuating quite often, so in a rising or falling interest rate environment, how would the fund adjust its strategy to cater to these different environments?
Yeah, that's an interesting question because I'm not only hired when interest rate is rising. Interest rate falling, I also need to do my work. So I think the important thing is that whether interest rate is rising or falling, I think one of the objectives of the fund is, we'll be on the lookout for better yield for the fund. So we're looking at different instruments that can potentially give us a better yield. But having said that, I think liquidity and safety is a very important consideration. So in the lookout of yield, we will also be mindful about the risk, about the liquidity profile of the entire asset that we invest in.
The fund offers a T+0 settlement, which makes it very rare, as in one of the few fund managers that's able to achieve this. How does this feature help the investors, and how do you benefit them?
In fact, at iFAST, we kind of pride ourselves that we are actually one of the early adopter of the T+0 settlement. Actually, for T+0 settlement, a lot of work have to be actually properly sorted out behind the scene, because it's not just only about investment, it's also the fund operation, and a lot of the back middle office work that we need to ensure that we're able to deliver this T+0 settlement. So in a nutshell, T+0 settlement means that if you were to put in a redemption request before 10 a.m., you will get back your money on the same day. And based on what I have observed, most probably you'll get back your money in the afternoon. So it will not be as good as you press in the ATM, you get all your money instantly, but your money will be back into your bank account within the same day. So that is what we call a T+0 settlement.
Kenny, so when you're managing a fund, do you prioritize minimizing risk or maximizing return? So how do you balance between these two factors?
I think that's a tough question, because to be honest, if I were to be able to offer the highest yielding enhanced liquidity fund out there, I'll be getting a lot of money. But the challenge there is that sometimes there are certain risks that you need to expose your fund to, especially on the liquidity front, that you may have to compromise a bit on the yield part in order to manage the risk properly. So I think there is a delicate balance that we need to strike. But I think from my perspective, the philosophy has always been trying to get a very decent yield for investors, but yet at the same time having this liquidity consideration, as the pillar, as the cornerstone of your whole process, so that when there's a significant redemption that comes in, I will be able to meet it and you won't get frustrated not having been able to get back your money.
Kenny, so the fund is currently managed in a few different share classes, so SGD, there's USD and CNH. Are there any plans on your end to introduce more share classes, and how differently are these share classes managed?
At this point in time, we don't have any intention to come up with another currency share class for the ELF. I think there's still pretty big room for growth in terms of the AUM for existing three currency, the SGD, USD and the CNH. I think CNH is because, as you know, China has not been very popular with investors over the past couple of years. So I think as people get a bit warmed up on China again, I think that CNH AUM, which is currently the lowest in the three ELF that we manage, most probably will have much room to grow. Yes.
What is the average return on the fund, and how does it compare with other peers in the same category?
Oh, actually, I would like to tell you that it's the best yield, but the honest truth is it is actually not the best yield out in the market. But then what I need to emphasize is that the yields are still reasonably competitive. Just to give you some perspective, currently our SGD ELF is offering a gross yield of about 3.2%. So I think a lot of the peers out there, some of them are better than us, but there are also some that's worse off than us. And if you minus away the management fee, which is about 30 basis points, so you still get a net yield of about 2.9% for SGD. I think which is not a bad yield. And for USD, there are significantly more competitors out there. And we kind of like use that because we also invest in some of the MMF's money market fund or the Enhanced Liquidity Fund that I mentioned earlier. If I start comparing with them, we are also reasonably competitive. Not the best, but our current gross yield of the USD is around 4.7%. So the expense ratio is slightly higher at about 45 basis points because the AUM is smaller than the SGD, currently just over 200 million US. So we still get a net yield of about 4.2, 4.3% net for USD. I think that's also, I wouldn't say the best, but it's still pretty good. For CNH, as you know, the interest rate in China has been relatively low. The gross yield, and this CNH fund, we actually collaborate with Lion Global Investor. So they are also one of the very famous enhanced liquidity fund managers out there. So they are delivering a gross yield of about 2.7% for the CNH. The expense ratio is slightly on the high side because the fund size is still very, very small. But we actually hope that it will get bigger. But I think the net yield of 2% is still reasonably attractive in the China interest rate space.
Thank you, Kenny, for sharing with us incredible insights. We have learned so much from Kenny. So if you are interested to find out more about the fund, you can invest through the iFAST Auto Sweep account, which invests 90% directly into the iFAST Enhanced Liquidity Fund. If you are interested to find out more and you wish to contact me, you can go through the LinkedIn, or you can go to the iFAST management website where you can have access to it. So thank you and look forward to seeing you in the next episode. Goodbye.